So today we have statement of cash flows. Statement of cash flows has become a very important part of the financial statements that provides information that isn't readily available elsewhere. Balance sheet tells us what the company owns and what it owes on a particular day, and the difference between, meaning the owner's equity. It gives us the income statement, which shows the revenues and expenses on an accrual basis. The statement of cash flows tells us cash that came in and went out in three major categories. It's vitally important because the most profitable company can go out of business. Why? Because if they don't collect their receivables, they still have debts to pay. How many people would work for a company that hasn't paid their salary during the year? Eventually, you're going to lose your employees. How many people will still get deliveries when they haven't paid their vendors? Not a whole lot. So it becomes important to raise cash from your operation to be able to expend cash in pursuit of the profit goal. And that's what you get from the statement of cash flows. There are three sections. There's cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities.
Kevin, mute your mic.
The net cash flows from each of the three sections, and they can be positive or negative, total to the net cash flows. If we take the net cash flow and add it to the beginning cash balance, we get the ending cash balance. And the ending cash balance, that number has to be the number that shows as cash on the balance sheet. Now, of all the statements to do, in a lot of ways, this is the most difficult. A lot of people have the most trouble with this. There are two methods we can use to prepare it. The indirect and the direct method. Users prefer the direct method. People that have to do this statement prefer the indirect method. Indirect method is a lot simpler to do, but doesn't give you the information you really want as a user. Up until recently, and it hasn't taken effect yet, but it will, FASB required, people who set standards for U.S. financial statements, required you to do the indirect method, even though they overwhelmingly recommend the direct method. So that means if you want to go the extra mile and do the direct method, you also have to show the indirect method. So you have to show it twice. You have to do it both ways. I adopted, for my financial statements, the direct method a number of years ago because I felt it was just way better for users. Anybody who's ever sat with an investment committee or an audit committee and gone through the statements who uses the indirect method, they usually say, skip it, because no one understands it. And while I could try to explain it, I'm all happy to skip it. With the direct method, everybody understands what happens. So when I had a chance to go to FASB and testify before them, I got finally an opportunity to ask something that's been burning in my mind. It came up, and we were talking about statement of cash flows, and they say, we encourage and prefer the direct method. So I got to ask, in what sense of the word do you encourage it? Do you encourage it by making me do it twice with an inferior method? Wouldn't you better encourage it by giving me the choice and not making me do the inferior method as well? Why do I have to cloud up my financial statements by doing it twice and having this ugly looking thing stuck in there? That's quite an encouraging thing. Is that the way you encourage your kids? Long story short, I'm not sure anything I said mattered, but they took away the requirement to do the indirect method. We now only have to do the direct. If you do the direct method, that's all you're going to have to show. The difference between those two methods is only in the operating section. No matter which of the two you use, investing and financing are done the same way. Basically, what we're doing conceptually is taking the balance sheet and the income statement and taking the information and putting it into one of these three categories. Generally, the operating section includes net income, net income being from the income statement, which really takes into account the whole of the income statement, current assets, and current liabilities. Investing takes into account non-current assets, and financing is non-current liabilities and the equity section. So if we have comparative balance sheets and the current year income statement, we have almost all the information we need. If we have a comparative statement of changes in retained earnings or owner's equity, we have everything we need. Of all the segments of the balance sheet, current assets, current liabilities, non-current assets, non-current liabilities, and equity, current assets, current liabilities, non-current liabilities, equity, non-current assets, and then the income statement, we've encompassed all those items. Investing, when we're talking about non-current assets, it's pretty easy to think about what we want to say. We're going to talk about cash used to buy. Whoops. Whatever non-current assets we purchased. It could be vehicles, it could be equipment, it could be buildings. And cash provided by the sale of non-current assets. So if we sold something to buy something. For financing, cash proceeds from debt issuance, or it could be cash provided by the issuance of common stock. Or cash used to retire debt, or cash used to purchase treasury stock. However, we've used cash, either provided it or used it for non-current liabilities and equity. Most of our time is going to be talking about operating, which we'll do an example to illustrate. There is one more piece of the statement that isn't numerical. It goes in the bottom, and it's called significant non-cash transactions. And what we do with that section is to treat things that aren't on the statement of cash flows, but could have been. And for instance, let's say we want to buy a building. To raise the cash for the building, we sell stock. We sell stock, we take the cash, we buy a building. So in investing, we have cash used to buy building, an outflow. In financing, we have proceeds from issuance of stock, an inflow. Together, they offset if they're exactly the same number, but they both appear on the statement. Instead, suppose I go to the owner of the building and say, instead of making me go into the market and issue stock to get the cash to buy your building, how about you just take the cash? How about you just take the stock? I'll give you the stock, you give me the building. So it works out the same to me. I know what the market value is. Let's do that. It doesn't go on the statement because no cash has changed hands. We didn't pay cash for the building and we didn't receive cash for the stock. So it doesn't appear on the statement of cash flows. But conceptually, how much different is that than issuing the stock and using the proceeds to buy the building? It's really the same transaction, just simplified. So we have a significant non-cash transaction section at the bottom where we put things like that on. Things that in other company might have shown on their statement, by the way the transaction was staged, it doesn't on ours. And those four, the operating, investing, financing, and statement of non-cash transactions are the four sections. This is key. Whenever I start the statement, I always figure out what the change in cash has to be. And until I get these three sections to total that number, I know I can't be finished. Because that number has to be the change in cash from the statement added or subtracted from beginning cash to get ending cash, and that has to be what's on the balance sheet. Any questions yet?
Professor?
Yeah.
The example that you give about significant non-cash transaction is like exchanging the share for building.
Right. Instead of selling the chair, use it.
Exchange.
Yeah. No cash changes hands, but you could have.
Yeah.
Then you show it. Yeah. Sorry. No problem. Okay.
But Professor, why they put it in the statement, cash statement? Because it's not a cash. If I should exchange
But the idea is to make the statements comparable to other companies. And the transaction isn't that much different than a company who issues stock to buy a building from one who just gives the stock to get the bill.
but the idea about the cash statement is just to know how the liquidity or how much liquidity you have, right?
But the idea isn't to not have things on there by virtue of how you conduct the transaction. So by bypassing the capital market, just giving stock to get something, you don't show it on the statement of cash flows.
Mm-hmm.
That changes two sections. So the idea is that you shouldn't be able to manipulate the statement by how you conduct the transaction if, in fact, it's substantially the same transaction as issuing stock in the market.
But it's going to show in the balance sheets, right?
The both balance sheets will be the same, so why shouldn't the statement of cash flows be the same? Well, we don't show it in the section, but we give the information in the bottom so someone can make their own adjustments. Can you see the spreadsheet?
Yes.
Yes.
Okay. This is also in Blackboard. So I made up this statement a while ago, and someday I'll update the years. But the idea is it's a comparative balance sheet, last year and the current year. And what we have are current assets. We have cash, accounts receivable, prepaid expenses, total current, non-current assets, building, equipment, vehicles, accumulated depreciation, total assets. We have liabilities and equity, current liabilities. We have accounts payable, salaries payable, income tax payable, loans payable is non-current, and then equity. So when we do the statement of cash flows, the last number, the bottom number, ending cash, has to be 200,000. The cash we show as cash at 12/30/109. When we total the three sections of the statement, what does the change in cash have to be? $50,000. Beginning cash is 150. In order to get to an ending cash of 200, the change in cash has to be 50,000. So I always start the statement from the bottom. I know where I have to wind up. In addition, we're also working with an income statement. We don't need it to be comparative, but it is. We only really care about the current year. So we have revenues, expenses, we have salaries, benefits, depreciation, insurance, so on, and net income of 800,000. Statement of cash flows becomes vitally important because let's say they had to pay all these expenses, but they only collected half of their revenue. The other half is still owed. What would have happened? Well, they would have had $5 million in revenue to pay $9 million in expenses. Can't last like that. So it's important for a lot of investors, a lot of lenders, to see how this translates into cash coming in and cash going out. And comparative statements of equity is important if there's any transactions in common stock. You have to know where the money, how the money was raised. So that helps to have the comparative statement.
So the bond is gonna be here? Bond,
The bond is not going to be there.
not in the equity statement?
No, bond would have been in the non-current liabilities.
But it's not showing here, but.
The only thing this shows is common stock, additional paid-in capital, and retained earnings. That's all that's going to be shown in the equity section. Traditionally, when we do statements at the beginning level, we do a statement of retained earnings. But in truth, it's never a statement of retained earnings. It's always a statement of all the elements of equity. So this is what we're used to seeing. Beginning retained earnings plus net income minus dividends. But we also show any of the changes in common stock and additional paid-in capital. The next step is to take the comparative balance sheet and add another column. The other column shows the change from year to year in each of the items. There's the 50,000 change in cash that we have to wind up with on the statement. Accounts receivable went up 950,000. Is that good or bad for cash?
Sorry,
Why is it bad?
not received. Okay.
It means that portion of your revenue wasn't received in cash. Accounts payable went down 250,000. Is that good or bad for cash? It's bad. It means not only did we pay all our current stuff, we paid 250,000 towards what we owed coming into the year. The effect on cash is positive if payables go up. That means we owe more, that means we didn't pay it. Payables go down, it means we paid more than we accrued.
There is no cash, or let's say the cash goes down. The cash will go down.
Cash goes down.
Yeah.
Yep. So when you think about it, how do we decide the effect on cash? There's lots of ways. We could reason it through. If payables went down, that means we paid for current expenses plus we started to pay off what was owed from a prior year. The way I usually like to do it is I like to make a journal entry. 1/2 is whatever account we're talking about. So to make accounts receivable go up, how do you make accounts receivable go up? Debit or credited?
Go up, debit.
Debit. So if we debit accounts receivable, the offsetting side of the entry is the cash.
Mm-hmm.
So a credit to cash does what to cash? Decrease. To make accounts payable go down $250, what do we have to do to accounts payable?
Put in
Debit. So I make the other side of the entry the cash. So I'm not really making these entries. I'm just in my mind thinking about the effect on cash by doing an entry. So if we have to credit cash, we're going to reduce it. Salaries payable went up $300,000. How do we increase salaries payable?
You say debit, salary.
With a credit. Salary expenses increase with the debit, but the payables increase with the credit.
Yeah.
So if we're crediting salaries payable, then we're debiting cash. What does a debit to cash do?
Decrease.
Increases it. So if you make the entry in your mind with the offset to cash, you'll know whether it's positive or negative effect on cash. And you really only have to memorize one of these. If a current asset increases, the effect on cash is negative. The current asset goes up, cash goes down. So you just have to remember that. If you remember that, you could do the rest. If a current asset goes down, what happens to cash? Goes up. If a current liability goes up, what happens to cash? And if a current liability goes down, cash goes down.
Jesus.
Okay, so we're going to first start with the indirect method. The indirect method we can construct with a simple spreadsheet and tie each of these numbers to one of the other pieces we've seen. The indirect method starts with net income. Net income was $800,000 from the income statement. The next thing we do is we add or subtract non-cash revenues and expenses. In this case, the one non-cash expense we had is depreciation. So we add depreciation back because it was an expense on the income statement. It reduced net income, but it didn't require us to spend any cash. So net income should really be higher by that million. Then we look at the changes in the current assets and current liabilities. Accounts receivable went up, so that's a negative effect on cash. Prepaid expenses went down. That's a positive effect on cash. Accounts payable went down. That's a negative effect. Salaries payable went up, that's a positive effect. Income taxes payable went down, that's a negative effect. We total that up, we get cash provided by operating activities of $225,000. We look on the non-current asset section, the one change we had was vehicles went up $250,000. So it was a use of cash, a purchase of vehicles. So that's negative $250,000. And I usually don't like to show a subtotal when there's only one number. So theoretically, if there were two numbers here, it would say cash used by investing activities. But since it's only one number, I just leave it like that. And then we have financing cash flows. Payment of dividends. That's a use of cash, so it's negative $200,000. Issuance of common stock is $1 million. Now, I think if you looked on the statement of retained earnings, you'd see that the issuance of common stock was $100,000. You have to remember the issuance also includes the change in additional paid-in capital. It's just the way we record it, we split it between common stock and additional paid-in capital. So we have to add those two together to get how much cash was provided by the issuance. And the payment of loans is the change in the non-current liabilities. It went down by $725,000. So the sum of these three is positive $75,000 cash provided by financing activities. Net cash provided is the $225,000 minus the $250,000 plus the $75,000 is positive $50,000. Added to the beginning cash balance gives us the ending cash balance. So mechanically, these are all tied into the other statements. This is linked to net income. This is linked to depreciation on the expenses, or it could be the change in the accumulated depreciation. This is linked to that spreadsheet where we added the extra column for the changes. And everything else can be automatic. It's pretty simple. But try to explain this to someone. I made the point to the FASB that when someone looks at the statement of cash flows, they're not thinking, let me see what my change in accounts receivable was. They want to know where the cash came from and where it went. And besides, if you have comparative statements, anybody can compute this for themselves. This doesn't provide any information any user doesn't have for themselves. A little bit of work. The better method is the direct method. Now keep in mind, the only thing that's going to change is this section here. And when we do the direct method, we still need to get to 225, cash provided by operating activities. This is what the direct method looks like. Cash provided by customers, cash used to pay salaries and benefits, cash used to pay other expenses. In this case, it has just a couple of lines, but it tells you, I think, what a user wants to know. Where did your cash come from and what did you spend it on? In some cases, you may break this up into more categories. For this company, they really just raised cash one way, and that was from selling goods or services. And they spent it mostly on salaries and benefits and their other operating expenses. If you have substantial items in here that you want to break out separately, maybe rent, maybe repair and maintenance, maybe cost of goods sold, you can. So you're telling the user things they don't know. How much did your customers provide in cash? How much did your employees take? And how much did everything else amount to? Comes down to the same 225, but I find it's more usable. What's the problem? Why doesn't everybody do this if it's better and it's preferred and encouraged? The big problem is a lot of people use accounts payable for all their items. Everything goes through accounts payable. And if you do that, then in order to get these numbers, you either have to look at credits to cash and figure out what relates to each of those lines, or break down the ending accounts payable. Two very difficult tasks. There is a simpler way, and that's if you have a payable or a receivable individual for each of these lines, not commingled, you could do the same spreadsheet. So when I was going to adopt the direct method, the year before I adopted it, I made sure I had enough payable and receivable accounts to relate to those line items. So to get the cash provided by the customers, most people already have that. I took the revenue, added the beginning accounts receivable, and subtracted the ending accounts receivable. That gave me cash provided by customers. Cash used to pay salaries and benefits. I took the two income statement items, salaries, benefits, and taxes, added beginning salaries payable, subtracted ending salaries payable. And then the other expenses I took from the income statement, then added and subtracted beginning and ending prepaid expenses, accounts payable, and income taxes payable. Same spreadsheet approach, but by not having one account I had to break down, it made it simple to do. And I could present it exactly the way I wanted to. Any questions about the statement of cash flows?
Your ending cash balance is $200,000 regardless.
Correct.
Where is it reflected on that third method you just showed? On this one, yes, but that third one you just showed.
The third one wasn't a method.
Okay.
There's two methods, indirect and direct. This is the direct method, and what I showed right after this was how we calculated these three numbers.
Okay, that's good. Yeah, okay, thank you.
Now, for some companies, this gets a little trickier. Net income might include gains on the sale of assets, gains on the sale of investments. If it does, we have to subtract the gains or add back the losses to operating cash flows, because we're going to show those under investing cash flows. But for the most part, for companies that don't have gains or losses on sales of investment assets, the only adjustment we usually make in operating using the indirect method is adding back depreciation expense. Questions?
The money that usually company preserve money or some money every year, right? And if they have, let's say, not a high income or something like that, they took from this money and they spread it or something.
Well, where'd they put it?
I'm thinking where they, how it shows it there.
It depends what they did with it. If they just left it in their checking account, it would just be a bigger increase to the balance. So we would just agree to that ending checking. If they segregated it and put it in an investment account, then it would show up as an investment. The excess cash that went to the investment.
What's about the money that they preserve or they save? Where they put this money or what they
It depends on how they're holding it. Remember we said this statement is going to agree to what we show as cash, that first line of the balance sheet.
Mm-hmm.
They could take, let's say they had $1.2 million, and they said, we don't need $1.2 million, we only need $1 million. So they took $1 million and they put it into an investment fund. They took the cash and it's sitting in an investment fund. That's not going to show up as cash anymore. It's going to show up as a use of cash to increase the investment, the non-current asset.
So usually I thought it's going to show, and because it's a cash already.
Well, the investments, this one doesn't have investments.
Because there's this.
But let's say we have a non-current investment of $1 million. What is that? We could own bonds, we could own securities. Some of it might be cash.
But how can we know it's cash or not?
It depends on what the account is that we put it in. If, let's say, we take $1 million and we give it to, let's say we give it to Vanguard. We don't know, just by knowing it's Vanguard, what the securities being held by that million are. We'd have to know what fund we were in. Suppose we gave it to a money manager. Suppose we gave it to Grantham Mayo Van Otterley, GMO. They may be holding it all in cash. It wouldn't make sense to pay a fee for that, but it could be. Or it could be securities. It could be equities. Just by knowing that it's in this, with this company, doesn't tell us what's being held. This statement doesn't do that. The footnotes to the balance sheet would describe the underlying assets of the $1 million. But this statement is just telling us that $1 million went to non-current investments. So it would say purchase of investments, or purchase of a mutual fund, or purchase of.
Let's say they didn't use it, they just put it as a saving.
Savings.
Yeah, because usually company these days, they save money because, as you know, acquisition, they want to acquisition any opportunity they in the market.
Well, let's just say they let their cash balance get bigger. So instead of coming down to 200,000, we'd be coming down to $1.2 million. And their cash balance would just be larger. If they had checking, checking of 200,000, like in this case, but let's say that other $1 million they put in a savings account. We would add those together on the balance sheet, and we would say total cash. And that's the number we would want to agree to.
But the title will be going to be saving.
The balance sheet would say checking accounts, saving accounts, total cash accounts. And then the $1.2 million is what we would agree to.
It will be affected in the cash statement or the cash flow?
Yeah. The $1.2 million is what we want this number to become, the total cash. In this example, it was very simple. It was just one account that shows as cash. But it would be the $1.2 million if they had a savings account as well. Is there any questions before we get to the homework? So we had exercises 1, 4, 10, and 11. So for each of these descriptions, we have to say whether it's an operating activity, investing activity, financing activity, non-cash activity, indirect method, direct method, depreciation expense, or cash return on assets. So it begins with net income and then lists adjustments to net income in order to arrive at operating cash flows.
Hi, how are you?
I'm good. How you doing?
Good. I just wanted to stop and say hi.
I appreciate it. Good thing I wasn't on a roll. So the first one, what is that?
The answer is a cash transaction involving net income. But I have a question.
Wait, cash transaction? That's not one of the choices.
Operating activities?
I'd say Probably not the best choice.
I'm looking at
11-1?
1-1, and the terms are 1, 2, 3, 0.
No, I'm starting with the description,
Oh, okay.
then matching it to the term.
I'll wait till I get to a question.
Okay. What starts with net income, then lists adjustments to get to cash provided or cash used by operating activities.
Operating,
Now we know it's an operating activity because we're coming to operating cash flows.
We just did that.
This is referring
Figure
to
it
the
out.
method.
It's referring to the method.
Indirect method.
It's the indirect method. So description A is indirect method. Items included in net income but excluded from net operating cash flows. What's an expense that's deducted in arriving at net income that we want to add back?
Depreciation.
Depreciation, correct.
It's an expense that no money is lost, but the value of what that is accounted for.
The expense reduced net income but didn't use cash, so we want to add it back. Net cash flows from operating activities divided by average total assets.
Cash return on assets?
Yes, cash return on assets. Cash transactions involving lenders and investors. Financing. Non-current liabilities and equity is financing. Cash transactions involving net income.
That's operating expense.
That's up, not expense,
Oh, sorry,
activities.
I have a question about that because cash transactions involving net income, but operating activities don't necessarily have to be that. Any activity, you could do operating activity in finance. Am I right?
Except the cash related to that comes from financing activities.
So hence it's actually cash transaction involving. Okay, that's why I didn't understand.
Cash transactions for the purchase and sale of long-term assets. I'll give you a hint. It's not operating and it's not financing. Investing, yes. Purchase of long-term assets by issuing stock.
Financing.
Yep, non-cash activities. Shows the cash inflows and outflows from operations such as cash received from customers and cash paid for inventory, salaries, rent, interest, and taxes. Is, and that makes sense. The direct method tells you cash provided by your customers and cash spent on X, Y, and Z. Any questions about exercise 1?
Are you gonna ask questions like this? in the
No.
class?
No.
Can we bank on that when it comes to this portion of the test that will in fact be the direct method and not the indirect method?
Nope.
Okay.
You can't bank on that.
I'd ask.
Good try.
Now keep in mind, even if you're using the indirect method for operations, investing and financing always use the direct method. It always says cash used to purchase, cash provided by sale of, cash received from issuance, cash used to pay. It's always the direct method for the other two. It's only operating that has an indirect method choice. We had exercise 4. Indicate in which section of the statement of cash flows each of these items would be reported. Operating using the indirect method, investing activities, financing activities, or a separate non-cash activities note. Now, something like this might be on the test, which isn't definitional, but once you have the change, knowing where to put it is important. So something like this might be. So you issue 20 million in bonds. Where would that go? And we're dealing with 3 sections. We're dealing with
It's finance. It's financing.
issues 20 million bonds, financing. But also say whether it's providing cash or using cash.
Cash proceeds from debt issuance.
Cash proceeds from debt issuance. Yep, so it's providing cash. Purchase equipment for $80,000. Investing. And what would we say? What would the line be in the investing section? Cash used to purchase equipment. Pays a $20,000 account payable.
Operating.
Operating, and what would we say?
Cash used to pay vendors or cash used to decrease liability?
Technically, no, because it's
No?
the indirect method.
Oh. So what's it called?
Decrease in accounts payable.
Okay.
Collects a $15,000 accounts receivable. Operating. And would it be positive or negative?
Positive.
Positive. Does receivables go down? So decrease in accounts receivable is positive adjustment in that section. The one before this pays a $20,000 accounts payable. Decrease in accounts payable is a negative adjustment in the operating section. Exchanges land for a new patent. Both are valued at $300,000. Non-cash. That at the bottom. Declares and pays a cash dividend of $100,000.
Financing.
Financing. What would the line say?
Cash used to pay dividend?
Correct. Loans $50,000 to a customer, accepting a note receivable.
Financing.
That's investing because you're getting money from it.
We're getting money from it,
If you're loaning them money, they'll pay you interest, right?
right? But we're only looking at the cash transaction. Is it increasing or decreasing cash?
Decrease.
Decreasing cash. We're spending $50,000. We're getting a note receivable in exchange. So it's going to be a use of cash. But in what section?
Finance.
Investing. Why? Because it's going to be a receivable. Receivables only come in 2 places. Current receivables in operating, non-current receivables in investing. Non-current assets are in investing. So if this is non-current, and I'd probably come down on saying I would assume it's non-current, it would be cash used to issue receivable, note receivable 50,000 in the investing section. Paid 75,000 to suppliers for inventory.
Operating.
It would be operating, and it'd probably be cost of goods sold, or, and well, in this case, it's inventory, it wasn't sold, so it would be,
Yeah, cash used for supplies.
no, cash used for inventory.
Inventory, sorry, inventory.
Cash used for inventory. Inventory probably went up, so it'd be increase in inventory, 75,000, negative effect on cash.
It's gonna be in the operation. It's gonna be in the operation.
Operating,
So the first one was financing and the cash was used for purchase bonds, is that what you said?
no, we didn't purchase bonds, we sold
Oh, you
bonds.
sold the issue.
Yeah, so the first one is financing, and it's cash proceeds from bond issuance. Any questions about 4?
Number 7, can you say?
Number 7, loans 50,000 to a customer. So it would be under investing, cash used to issue note receivable. Because it's a negative cash, we spend 50,000 in exchange for a note receivable. Then we had 10. Exercise 10, we have comparative balance sheets, some additional information, and prepare the statement of cash flows using the indirect method. So how does the statement of cash flows using the indirect method begin?
Net income?
No.
You have to add or subtract the non-cash.
How does any statement begin?
You need a heading.
The heading. It's been too long between the last time we had the heading come up as an answer.
So if you don't have the year there, we shouldn't put the year, right?
We do have the year.
No, but I'm asking that if you don't have the year, we should.
You should use as much information as you have, but don't make up information that's not there. Yeah. So if you have December 31st, but not the year, you could say for the year ended December 31st, comma, XX. But don't make up the year. In this case, we have the year. So we would start off at the top. I won't write it down to save space. Plasma Screens Corporation, statement of cash flows for the year ended 12/31/18. So cash flows from operating activities, we'll start with net income. Net income was $79,000. Then we have a line that says something to the effect of adjustments to reconcile accrual basis to cash basis. First thing we're going to add back is non-cash expenses. The one we always look for first is depreciation. How much was depreciation expense?
150,000.
How do we know that?
It says it on the bottom.
Says it is
Additional
item 3.
information.
Do we need item 3 to tell us?
In this sense, yes.
If you didn't have item 3, what would you do?
Look out on the income statement. Or
We don't have the income statement.
The difference between the 2015 and 2000.
accumulated depreciation.
18 and 17, yeah. 2018, 2000. Oh, you have a different book. Yeah, 3 years different. But you're right. We would look for the change from this year, from last year. Not always reliable, because sometimes we may have sold fixed assets and taken the depreciation out as part of the adjustment. So it is handy to have item 3 to tell us. But if we didn't have that, the next best thing is just subtract the 2. So we have net income. We have the non-cash expense. What do we do next?
Changes in our liabilities.
No, not yet.
We're still doing non-cash.
We're still doing,
Increase of 15,000 for the accounts receivable.
actually, decrease.
Oh, it's decreased? Did I go the wrong way?
Yeah, it was 97 last year. It's 82 this year.
No, so I went backwards. Okay.
So it's decrease in accounts receivable of 15. That's going to be a positive adjustment. So what we're doing is we're taking the changes in the current assets first, then we'll do the changes in the current liabilities. Then we have increase in inventory. How much did inventory go up?
$16,000.
16. So that's going to be a negative adjustment. And prepaid rent went up 3. So increase in prepaid rent. It's going to be a negative adjustment.
Professor, why there are adjustment here? Is it in reality happen? Adjustment that we get it now. Is there because it's already the cash flow statement there.
Well, don't forget, it's a cash flow statement, but net income doesn't represent cash. Net income is accrual basis. So all the revenues are all of the expenses. We haven't said anything about the effect on cash. So if we weren't going to adjust it, we might as well just look at the income statement. What we want to do is take that income statement and the net income, say how much of that really represents cash. And we do that by saying if we made adjustments like receivables, that affects the cash we collected during the year, but it may not be reflected in revenue and therefore not in net income. In this case, accounts receivable went down 15,000. That means we collected all this year's revenue plus 15,000 from the prior year. So we have an extra 15,000. We need to make that adjustment to show that the cash provided was 15 more than by looking at net income. And then we have to do that adjustment for each item of current asset and current liability.
Even if I receive money later for the last year, I'm gonna add it to the last year. I adjust it.
This year, we're talking about the cash received this year, and receivables mean previously made sales.
Yeah.
So if receivables went down by 15, that means we have an extra 15 that's not reflected in net income because it relates to the prior year.
So I have to adjust the last year, or
No, it's this year.
okay.
It's when the cash comes in. So it's on the cash flow statement for the year the cash came in. The income statement is the revenue for the year the revenue's earned.
Mhm.
Now we want it to be adjusted for when the cash actually changes hands. That's why we're making these adjustments. What happened to accounts payable? How much did it go up? 15,000. So that's going to be a positive adjustment. This means if accounts payable went up, we didn't pay for 15,000 of those expenses that we reduced net income by. So we're going to add it back since we want to get net income to be in a cash basis number.
That's accounts payable, not receivable.
Thank you. Decrease in interest payable. How much did interest payable go down by? Went down by 6,900. Then we have increase in income taxes payable.
4,000.
Went up 4,000, so that's a positive adjustment. Do we have anything else for the operating activity section? Nope. So we just have to add it up. So what do we get?
$200,000. $237,000.
Is that it? 237,100.
So there's 149, 146, 161, 165. 165 minus 6, so 165 plus 79. 165 plus 79. 44 minus 6,900. 237. Not that I didn't trust you. So any questions about the operating activity section? Then we have cash flows from investing activities. And where are we going to look at for investing activities?
Question number 10, right? Item 2, since we bought.
10.
9 2, since we bought. $110,000.
Okay. If we didn't have note 2, where would we look?
With the investments.
No, we look at the change in long-term assets. Land stayed the same at 530, but equipment went up 110,000. So if we didn't have item 2, which says the company purchased 110, we would have just subtracted last year from this year. So the one item we have is cash used to purchase equipment. We have cash flows from financing activities. Where do we look at for the financing activities? So we've taken care of the income statement, current assets, current liabilities, non-current assets. So what's left?
Item 4 says they repay $152,000.
Yeah, but before we get there, what are the sections we're going to be interested in honing in on? Non-current liabilities
And equity.
and equity. So let's start with non-current liabilities. What's the one non-current liability?
Notes payable.
Did it go up or down?
Decreased.
Decreased.
115K.
So cash used to pay note payable, 115. Did we issue any stock? No.
No.
How about any dividends?
Yes. 1 of 30,000. Decrease.
Anything else in financing activities? All right, so let's hold that breath and see how we did. So we're going to have net cash used by financing financing activities. $145. Net cash used. So we have 145 plus 110 is 255. 255 minus 237.1
17900.
is 17.9.
17900.
17,900.
17,900.
Yeah.
I think you kept saying 117.9.
I said 17900. 17900.
179,100. No, 17100, right? 17900.
Yes.
17,900. How much was beginning cash?
126,800. I'm sorry. No, 97,000. 97,000 was needed cash. I was at current assets. I'm sorry, that's the wrong column.
That's 126.8.
That's current assets, not beginning cash.
That's cash. There's no subtotal for current assets.
For this year or for the last year?
Last year.
Last year it says cash was 97,000.
What's accounts receivable? What addition do you have?
I'm sorry, I just read the wrong row.
We agreed on 126.8?
We are very much.
Beginning cash, 126.8 minus 17.9. Is that 108.9? Yes. All right, I'll let you do this one. I usually give it a big booyah when it works. So when this agrees to the cash that's shown for the current year, 2018, we know we did it right. So cash for 2018 is 108.9, and that's what we get. Now, we could still be wrong. We could have one of these numbers in the wrong category. We'd still mathematically get the same number. But if this isn't the cash we show, then we know we're definitely wrong. Now, this is a good test question also. Any questions about exercise 10? The last exercise is 11. So you could have your text, you could have notes. You could also print out the answers. And if you find the problem in the book that's similar to the test question, you could look at the answer for the book and kind of relate it as an analogy to the test question. Yeah, I'm not going to, as long as it's paper. You bring whatever paper you want in.
I didn't know that.
You weren't here when I announced it. Yeah. Snooze, you lose.
Yeah, right.
Imagine if I didn't mention it again, you just show up with nothing. Everybody else has books all over the place.
Well, prepared, yes.
Yeah, I'll say it again for anybody who wasn't here when I said it. It's going to be open book, open note. Anything on paper is fine. Nothing electronic. No laptops, no tablets, no smartphones, no devices that can communicate. Do the calculator?
Yeah.
Calculators are good. All right, then we had exercise 11. Prepare the operating activities section of the statement of cash flows using the indirect method. So we have an income statement, and we have some current assets and current liabilities. So all we need to do is the operating activity section. Now, we're not doing the statement. When we do a statement, how does a statement begin?
Date.
Heading. Date's the third part of the statement. Name of the company, name of the statement, date or period of time. We're just doing the operating activity section, so we don't need a heading on a portion of a statement. So how does the indirect method begin?
In net income.
Nothing.
Net income.
Well, the heading.
No.
We just said no heading is necessary just for a portion. But if you're going to be wrong, always be wrong saying heading. How much was net income? $130,000. Then we have the adjustments necessary to reconcile accrual basis to cash basis. The first one is we're going to look for depreciation. How much was depreciation expense? $60,000. Then we're going to have the change in current assets and current liabilities. Now, always remember, we don't include cash in this. Cash is going to be at the bottom. So always skip cash. If you include the change in cash in here, you're going to get a wrong answer. So start after cash, we have accounts receivable. Accounts receivable went down. How much did accounts receivable go down? 8,000. Is that a positive or negative adjustment? Positive. Inventory went up.
Negative.
Cash goes out.
Prepaid rent went down. Positive or negative adjustment? Positive. Why? The decreased prepaid rent, we credited, so that means we left with a debit, that increases cash. We could also think about it by what it means. We had this account prepaid rent. When we decrease prepaid rent, what do we increase? What do we debit?
Cash.
No, that's for the purposes of figuring out the debit or credit. But during the year, when we credited prepaid rent, what did we debit?
Rental expense.
Rent expense. So we increased rent expense by $3,000. That reduced net income, but did we use cash? No, we used prepaid rent. What was it?
Sorry, went off.
No, it's okay. What kind of ringtone was that?
A stupid one.
One time I let my intermediate accounting, the undergraduates, select my ringtone. And I happened to be at a fairly high-level meeting when Shakira Hips Don't Lie. I forgot to mute the phone. And I was stuck with it. I promised them for the semester. And at the time, my 11-year-old daughter made me promise not to take the phone when her friends were around. So I don't know how that how bad that is in relation.
Well, I mean, it wasn't Shakira, thank God, but still.
It's a pretty catchy song. So if prepaid rent is decreased by crediting and we debit rent expense, then that rent expense is reducing that income, but not using cash. So we got to add it back to get the cash basis effect. Accounts payable went up 13,000. Positive or negative?
Negative. Positive.
Positive. Payables went up that means that portion of expenses wasn't paid in cash. We still owe the money.
And income tax payable went down 9,000.
Positive or negative adjustment?
Negative.
Negative. So there we have it. Now all we have to do is add it up. We have 130, 60, 190, 198, 173, 176, 189. It looks like 180.
So we did 2 examples of indirect methods.
Yeah. So I'm kind of stuck not doing a direct method, in fairness, yeah. I would agree. If that was your point, I would agree.
So can we just leave it as this instead of doing another one? No, I'm just.
Okay, so any questions about 11? Okay, so we have some time, so let's go over everything for the test. We have Chapter 6, Inventory and Cost of Sales. Chapter 7, Long-Term Assets. Chapter 8, Current Liabilities. Chapter 9, Long-Term Liabilities. Chapter 10, Stockholders' Equity. Chapter 11, Statement of Cash Flows. So 1, 2, 3, 4, 5. 6 chapters. No? I counted wrong?
6 chapters.
6, 7, 8, 9, 10, 11?
Okay.
So how are we feeling about the 6 chapters? 5? All right, so I'll tell you what. They'll each chapter of, I'll give you 6 questions, let's say. But you only have to choose 5 to do. So
Perfect.
only 5 will count. So instead of 6 being worth like 16 points each, you'll have 5 worth 20. So if you do all 6, I'll take the 5 highest score.
Okay.
Level the field. The 6 is a lot. And personally, I hate these 3-hour classes. You got to show up having read the chapter, tried the homework, done everything, and I prefer to teach the class than the next class do the homework. But it doesn't work on these. I tried this a couple of times at this type of class, and so before the test, you have the homework from the last chapter plus the homework from this chapter. This next week's the test. So it just compresses it and makes it worse. There's just no good way around it. So you'll have 6 questions. You only have to answer 5. So from now, if you want, you could pick 5 to study and answer the 6th. Maybe it'll be an easy one you just happen to know. If not, if you get like no points, so you got 5 that will count. So how you feeling about the other chapters?
Trying to figure out like what you're gonna ask us by the homework. So what we've had more of is probably what's it's like how we used to see the cash flows. It's gonna be,
The indirect method.
so like that's kind of how we teach it. Like most type is probably the same.
Yeah.
Like for chapter 6, for inventory, how you went over the periodic method, perpetual, so would you normally ask how we do both methods? Like if you do
It depends, you know, if I'm doing a test that only has 2 chapters to be covered, I would expect you to do the different accounting systems, the different inventory systems, LIFO, FIFO, weighted average in both periodic and perpetual, as well as the journal entries for acquisition of inventory, freight, and things using perpetual and periodic. But since you have 5 chapters, it's going to be a little different. I'm not going to ask everything. So chances are I'll probably, it might just be the entries related to inventory, freight, and things like that using, or sales, purchase return, purchase allowances, either perpetual or periodic, or it might be these units at this price was bought on this day, so many units were sold this day, then these units were bought on this day. Tell me the ending inventory balance as well as cost of goods sold using LIFO, FIFO, and or weighted average. Long-term assets could be a variety of questions. Building was bought. Here are the items paid at closing. How much gets accrued as part of the cost of the building? How much is part of the land? Might have to do with depreciation, using the different depreciation methods, life, figure out, and salvage, figure out the annual depreciation.
It's easy to follow, you know, the exercises that you've given us in class, but when you're trying to compare some of the questions from the book to this, it gets a little tricky.
Oh yeah, I gotcha. So let's go through chapter 6, right? Let's go to the brief exercises and exercises. So we're in chapter 6.
We have, how many methods we have in inventory? We have 5 for life.
We have 3 systems, 2 methods. We have perpetual and periodic,
Okay.
LIFO, FIFO, weighted average. So 6 altogether. FIFO perpetual, FIFO periodic. LIFO perpetual, LIFO periodic, weighted average perpetual, weighted average periodic. And we also know that FIFO is the same perpetual or periodic. So we could kind of call it 5 different answers, 5 unique answers. So if we start in chapter 6 with the brief exercises, and this is the 4th edition. Brief exercise 5.
Review the 3rd edition.
Oh, you want to bring the 3rd edition up? Yeah. You want me to mark them as I go, or are you going to make a note?
Oh, I will take it from.
Yeah.
Did you say brief exercise?
So now I'm in the 3rd edition. The 3rd edition, brief exercises. Brief exercise 5, 6, 7. 10. 11. 12. I'm not saying all of these are going to be on the test, but I'm just giving you all the ones that look like something that might be on the test. A lot of them are repetitive. 13. 'Now I'm going to the 4th edition. Chapter 6, brief exercises, 4th edition. 5, 6, 7, 8. 10. 11. 12. 13. Now the exercises. Exercises in the third edition.
Is that for chapter 7?
No, still 6.
Oh,
We only did brief exercises. Now we're doing exercises. Third edition, chapter 6, exercises. 1, 2, 3, 4, 5, 6, 7. Fourth edition, chapter 6, exercises. 1, 2, 4, 5, 6, 7. Chapter 7. Third edition, brief exercises. 1, 2, 7, 8, 7, fourth edition. Brief exercises. 1, 2, 7, 8. Third edition, chapter 7, exercises. 1, 3, 10, 11. Fourth edition, chapter 7, exercises. 1, 2, 10, and 11. Chapter 8, third edition, brief exercises. 1, 2, 3, 5, 7. Chapter 8, fourth edition. Brief exercises. 1, 2, 3, 4, 5, and 7.
I have one question for manual solution, especially with the third edition in brief exercise 8.5.
Yeah.
Yeah, here you put in the answer is different. Here I don't know how to calculate this one. 110.
That would be the maximum
Yeah,
that was in effect. It would have to be, the maximum would have to be given to you.
It's
but
not,
it doesn't give it here. When we can know the maximum.
Assuming the FICA base amount is
113,700.
so that really should be 113.7.
Ah, 7.
I have a question. Listen, it says it's gonna be some questions says 113.7 is the maximum, or let's say the FICA, but it's if it's further more or it's more, it's gonna be different person.
FICA is a combination of Social Security and Medicare.
Yeah, I'm not saying what the meaning, but I don't understand if it's gonna go exceed more than 100.
For Social Security, the 6.2%, it's only up to the maximum. Anything beyond that is not taxed for Social Security.
Because there are a question in the exercise, the same concept. Because really, I understand a little bit what does the meaning Social Security was. And the question says it's FICA tax are 7.65. I'm and the exercise 8.7. I'm reading the exercise 8.7.
8.7.
Yeah. Exercise.
Exercise 8.7.
Yeah.
Okay. Exercise 8.7. Okay.
FICA tax are in the 5th line. FICA tax are 7.65% of the first 113,700 earned by an employee and 1.45 therefore.
Right.
Therefore. Yeah.
Thereafter.
Thereafter. This is mean. How I can calculate it? This is mean 113 with second.
Because there's two pieces to FICA: Social Security, which is 6.2, and Medicare, which is 1.45. The Social Security stops at a maximum. In this problem, it's 113.7.
If I go more than 113,
only the Medicare 1.45 is still taxed.
So let's say it's if there are 100 more than 213,700. That means the only 100.
So we have Social Security. We have Social Security and Medicare, 6.2 and 1.45, totaling FICA of 7.65.
Okay.
So let's say the maximum is 120,000. I'm just making up a round number. That only applies to Social Security.
Okay.
So let's say one person made 500,000. Social Security would be 120,000 times 6.2%, and Medicare of 500,000 times 1.45%. Which, the way they wrote it in the book, is saying FICA of 120 times 7.65, and then 380 times 1.45. These two are equivalent, just stated differently.
But in the first one, you put 500 multiplied by 1.45.
Right.
And the second one is 380.
But in the first case, it's only 120 times 6.2, where it's 120 times 7.65. See, this the way they phrased it in the question you asked me, they said FICA of 765 on the maximum, 1.45 thereafter. in my mind, I like to treat them separately. Social Security to the maximum, no maximum on Medicare. You're going to get the same answer.
I get it.
It's just the way they
They
stated
increase the
it.
percent. They increase the interest or the tax. But you did it the same number, but you would change the interest.
Yeah, it's the 120, the maximum gets both pieces, then only the smaller percentage thereafter.
I get it.
So where was I?
You're gonna have the exercises for third edition.
Exercises for third edition, chapter 8. Exercise 2. Exercise 3. Exercise 5. Exercise 9. In the fourth edition, exercise 3. Exercise 5. Exercise 9. Chapter 9, third edition, brief exercises. Brief exercise 5, brief exercise 6, brief exercise 7. Fourth edition, chapter 9, brief exercises. Brief exercise 6, 7, and 8. Third edition, chapter 9, exercises. Exercise 6. Exercise 7. Exercise 8. Fourth edition, chapter 9, exercises. Exercise 7. Exercise 8. Exercise 9. Chapter 10, third edition, brief exercises. Exercise 3, brief exercise 3, brief exercise 4, brief exercise 5, brief exercise 7, brief exercise 8, brief exercise 9. Fourth edition, chapter 10, brief exercises. Brief exercise 3, 4, 5, 7, 8, and 9. Third edition, exercises. Exercise 3, 4, 5, 6. Fourth edition exercises. 3, 4, 5, 6. And chapter 11, third edition, brief exercises. Brief exercise 4. Five, 6, 11, fourth edition, brief exercises. Brief exercise 4, 5, 6. Exercises, third edition. Well, the ones we had for homework, which were 1, 4, 10, and 11.
We should check those. No.
I would just stick with those.
1 part.
1, 4, 10, and 11. So any questions about the test? Once you start the test, there's no leaving until you're done.
How much time do we have?
3 hours, 6:30 to 9:30. All right, if there's no questions,